Welcome everyone to BlockRocket's panel, Institutionalization of Digital Assets. So before I hand over to Saga, our moderator today, to start the event, I would like to give you a quick introduction about the event logistics. So as this event is going to be big, everyone is going to be muted except for the speakers. If you have any suggestion or question during the talk, please join our WhatsApp group by scanning this QR code, or post in the LinkedIn group that I have shared with you in the event reminder. And we will make sure to send Saga on the questions, and he can then pick the question to answer during the panel. I hope you enjoy the event today. And now I will hand over to Saga. Saga, do you want to introduce yourself and start the panel?
Sure. Thank you, Alexandra. So good afternoon, everyone. Welcome to our another fantastic panel event on institutionalization of the digital assets. Before we move further into our panel event, I would like to quickly introduce about myself. I'm Sagar Barwalia, Head of Venture Development at BlockRocket. BlockRocket is an early-stage startup investor and accelerator program based in Germany. We invest up to 250,000 euro in pre-seed and seed startups. Our main focus is blockchain. We are very blockchain agnostic. Once we invest into startup, we help our startup into matchmaking and marketing, advisory and mentorship. This is our partner ecosystem, which we have developed over the years. We have 250 plus partners around the globe working actively in blockchain space, which include 30 plus VC networks, 20 plus law and advisory firms, corporates, and startups. So in nutshell, basically you can say, you can tell us a younger version of any acceleration program exists in the world, like Y Combinator, plug and play. But as you see, BlockRocket is very blockchain agnostic, and our main focus is German ecosystem. So we have sophisticated application process. If you are looking for funding, you can apply to us through our website, which takes 4 to 6 weeks before we reach out to the investment decision. So this is our team. We would like to keep in touch with you. You can follow us on Twitter, Instagram, or LinkedIn, or you can also directly reach out to us on our website. So let's keep in touch. And moving further, I would like to ask our panelists to introduce about themselves one by one. Then let's start with Christoph from Bitwala, previously Bitwala.
All good can happen. So I'm Christoph. Nice to meet everyone here. I'm looking forward on the panel. I have a background in traditional banking, traditional finance. So perhaps one of the things which makes me a panelist here, worked 10 years for LBBW, huge institutional bank in Germany. Also one of the German banks who, but totally unconnected to me now, is looking more and more into blockchain related financial products. So I love that my old colleagues are moving into that direction. Now I'm a CFO at Newary, former Bitwala, which is placed as a neobank in the cryptocurrency space. And we are also extending our product portfolio into more blockchain-based financial products, obviously securities on the blockchain, DeFi products on the blockchain. These are things we are looking into to connect our core product, a neobank account to.
Thank you, Christoph. Moving further, I would like to ask Pavir Patel from Bitpanda Pro. Pavir, please introduce.
Hey, Sagar. Thanks for having me on the panel today. So I work for Bitpanda. Bitpanda is the leading European crypto exchange, and we've recently launched stock trading. Have about 3 million in customers across Europe overall. On the Bitpanda side, I look at the pro business that's for advanced traders and institutions. And prior to this, and I'm fairly new to the crypto space, only joining about 2 months ago. I did my time at JP Morgan for almost 7 years. Most recently, I was setting up the fintech team within Hong Kong, and then before that, spent some time in London on a few different roles.
Thank you, Pavir. Moving further, I would like to ask Ehab from Breach Insure.
Thanks, Sagar. I'm co-founder and CEO of Breach Insurance. We are a regulated digital crypto insurer, starting out with a consumer retail cyber theft insurance solution, moving into commercial, hopefully further in 2022. I have a background in insurance. I spent 10 years building new products and technologies for the insurance industry. Prior to that, I spent 12 years in the energy industry and corporate finance and corporate accounting.
Thank you, Ehab. Our next panelist is Moritz from Trality. Moritz, can you hear me?
Yes, I can. Sorry about that. Thank you very much for the invitation. My name is Moritz. I'm co-founder and CEO of Trality. We are the platform for anyone to create and invest through automated trading bots. I have a background in finance as well as general project management and business, and came to our product sort of from the private side, started trading crypto and also other asset classes heavily, and just realized that as a private individual, you're very much fighting against windmills when you're going up against the big funds and banks and hedge funds. So we built this platform to help anyone to benefit from the power of automated investing. So far active in the retail space, however, also considering actively moving into the institutional space. And from that perspective, obviously very interested in contributing to the panel today.
Thank you, Moritz. Last but not least, we have Gregor from Solidum Capital.
Hey, Sagar, nice to connect and thanks for the invitation. Yeah, I'm co-founder and CEO of Solidum Capital. We are a company that provides treasury management solutions to crypto startups, different services. The core one is the asset management, where we actually manage part of the treasury with our quant strategies. And we also have the algorithmic token sales, the service that we provide to teams, so the companies and the founders, if they want to sell their native tokens without any impact on the price. And we have some other services also, of course, in play for the future. And that would be, in short, all we work with professional investors only, and that is our strategic decision. So also happy to contribute to our today's panel. Looking forward.
Thank you, Gregor. Thank you all the panelists for wonderful introduction. Moving further, before I move further and I open the panel discussion, I would like to ask all the audience, they can check into our WhatsApp group or go to our LinkedIn page. And if you have some questions, feel free to write there. And I would like to take some of the question before we end up the question. So we'll have like last 10 minutes for the Q&A session. So feel free to post your questions. And so let's start the panel discussion. So I was reading through some articles on NASDAQ, like Nest point out that in 1950, only 8% of the value of shares traded on the US market was owned by institutions. In 2010, this figure soared to 67%. So let's put another way, like whales are instrumental for mainstream integration and exponential growth. So my question here to the panelists is, why institutional adoption is so important for the crypto space? Maybe we start with the Christoph.
So thanks for the introduction to the topic, and I only can underline that. That would be also my take on basically on this panel coming from a retail untraded product. There is the biggest difference between both worlds is that if you are making investment decisions on your own, you can take way more risks. It's affecting you. You don't take the risks for others, and you can experiment more. And in the huge community of retail investors, there's always early adopters. We all know the stages: early adopters, early majority, the chasm, and all these theories. And if you have like this wide audience of retail investors, there's people who are willing to take risks, perhaps even too much risks. And with an institutional investor, you have obviously procedures, you have managers, you have superiors, you have a board, you have shareholders. So you have way more reliability on your decisions than you would take them only on your own. And I would argue that has two effects to answer your question directly. So first of all, if the crypto market, or let's call it wider blockchain-based financial products, including DeFi, NFT, whatever, is adopted by institutional investors, we basically know that we made it. So we know that the market has emerged, that the market is educated, the market is grown up into an area in which people who need to avoid risks are willing to take these risks because they are covered properly.
I think there's a few interesting things when we think about institutional adoption. The first is obviously as investments, which has increased a lot last year from brand name hedge funds like Portage Jones, BlackRock, and the like. I think the second one, which is kind of more nascent, is like participation actually within these kind of crypto ecosystems. I think even Visa, buying a CryptoPunk as an NFT kind of evidences some, leaning and toward like participation toward at least the ownership of assets and participation with the ecosystem. But I think we'll eventually get to people being able to vote on, in decentralized autonomous organizations, which is very much like, stocks and shares voting too. So I think the investment's coming already. The payments is kind of being stop and start, but will come eventually. And the last one I think we'll get is participation from institutions overall.
I've got a little bit of an alternative perspective. I don't think that the retail market really cares if, institutions get involved or not. But I do think that there's like value in other factors that are at play. There, in terms of regulation and in terms of advocacy, it's really hard for retail to advocate for itself. So I think as institutions get involved, I think it brings validation to the market, but then you also have them getting some exposure and them having some skin in the game to lobby and advocate for the broader crypto market, how it's taxed, how it's regulated, whether it's a security or not. All these things that take place, it's going to take some time and a lot of money and leadership. And I think that with these institutions involved, it kind of helps push that along. All of a sudden, we hear about, certain things coming around, and all of a sudden it's not illegal to own crypto anymore. The question is, how is it taxed? So it's an interesting dynamic, but I think for very different reasons than validation, in my opinion, at least.
Yeah, great. Maybe also add, you have different types of retail investors, so to say, and there are some really early stage adopters, right, who are the first one really pushing this through. But there is a type of investors, of retail investors, who first want to see institutions coming in, and then only they will become comfortable. So I would say there's also a huge pool of maybe even a bit older, let's say, investors, right, who still are reluctant to crypto. And when they will see really big names coming in, and there are many big institutions coming in, then only they will come via ETFs, which are coming sooner or later, or some other vehicles, right? So I would say that both groups actually help each other on the path to broader adoption. That's my view on that.
Understood. Moritz, if you would like to add something, maybe.
Yeah, I think ultimately we did see a big push in the market over the last, well, at least, if you remember back to the last fall, last winter, where all of a sudden, following these big investment names, and I might include Stripe and PayPal and Cash App and the likes in here as well. We did see a big push in the market, so it does bring validation, I think, as can be seen from the Bitcoin price itself, right? Ultimately, of course, especially for those names that I just mentioned, we're also talking for an ultimate B2C product here. But nonetheless, the fact that these companies did go in, it did bring validation. So yeah, I see both sides here, I think.
Understood. I mean, the regulation is also not going to kill some sort of like a new innovation, right? So regulation should be in certain limits that doesn't kill the new innovation, but regulation is also kind of like inevitable in the long-term sustainable growth. For example, without the regulation, as you guys discussed, like some people like retail investor even waiting for like big people to join into this space. So let's talk about like the key issue for like risk-averse fund managers are like security risk, market risk, and custody risk. I think lots of things have been already built on the crypto space. For example, we have like so many custodians which are already like in their particular jurisdiction, like they are compliances with their local body. For example, Coinbase just rewarded the BaFin license in Germany. They are like compliance with the US government. So I mean, what are the key issues we are still lacking or like barriers for the institution to enter into this space?
So I think initially the institutions have entered into like financial product wrappers, which they're used to, like an ETF, a trust, an ETP. And I think there's now more of a desire to get direct exposure. And this is where it feels like there's maybe a gap in either like service providers are more nascent and less well adopted. less well kind of positioned and know how to speak to institutions in their own language. But that's changing rapidly as more and more people hop over from traditional finance into the crypto world. And also, I would say, just more clarity on the regulations overall. Like special funds in Germany weren't allowed to invest in crypto assets until like a month ago, 2 months ago. I think that type of regulatory clarity is definitely needed for broader adoption.
Understood. So how is the in general sentiments, Christoph, in Germany? I'm sure you are quite active in this space, but maybe you can say some words about like what is the sentiment right now in our country?
I really think, and I don't want to advertise Germany here, or like have fake patriotism or whatever, but like the German crypto custody law is like really a breakthrough, especially for institutional investors. I would say for retail investors, it doesn't make such a big difference. It gives them also more securities and can give more convenience on key storage, etc. But most retail investors will not care so much. But for an institutional investor, it plays a huge role if the party I trust my keys with is a party which in a certain way is regulated, needs to follow a certain rule set of how internal procedures are handled, how is a potential internal fraud case prohibited, who are the managing directors of the entity I give my keys to. And that is a really important cornerstone. If I need to go, like, again, in an asset manager, in a fund, I have a board, I need to go there and tell these people, hey, we want to invest in a certain crypto product. Okay, and who's storing that? Who's the custodianship? And I say, it's regulated. These guys are audited. They had an application which was approved. That gives you the credibility to actually go into that room and convince someone to put like not only some 100 euros, some 1,000 euros, but like millions in a product, and not get their heads cut off if something goes wrong, right? And I think for the institutional side, this is an extremely important way to move forward, also because custodianship of the keys is so important, because like I can hold my keys somewhere, I can have my 12 words somewhere around, but like you cannot work with that in an institution, in a corporate setting. So who has the keys? What if that employee leaves, or what about internal fraud cases, etc.? So you need to have a certain rule set and procedures around the whole private key setup, which is key to blockchain-based financial products. And I think there we made like a real effort.
Completely. Sorry, just one point to add, and maybe also a question to my fellow panelists. I completely see these points, and I see these advancements that we've made here. However, I sometimes also have the feeling that we in the industry, we of course have a very, I don't want to say biased, but we at least we see all the positive developments that I would say, let's say common board member of an institutional investor, of a mutual fund, of a pension fund, you name it, doesn't have, maybe not. So as a manager, to convince these people to really go out and put a large investment into crypto assets, even if it's only Bitcoin, I think is still very, very difficult just from a perceived risk point of view. I remember, just the time a couple of months back when all of a sudden the energy consumption debate came up again. All of a sudden, a lot of investors on the B2C, in the private retail side, but also in the institutional side, got scared again, and we're wondering. And I don't think we're at a point yet where it's really an easy job for a fund manager to convince a board or takers to make these kind of investments. I don't know, how do you guys see this?
I agree on that. I think these changes in the legislation, like Germany did, we discussed the law. It's very important, but I would say share the view with Paul Moritz here. Basically, when you're an employee in a large institution, you're worried about your, let's say, position, and you will not take risks very easily, as Christoph said before. It's a process, it's everything, and you're accountable for that. So you will not be the first one to invest into Bitcoin if none of your peers did it, right? And the other thing is really this counterpart risk. So you have Coinbase granted license, for example, but Coinbase, in eyes of many traditional institutions, is still a startup, and they will not trust Coinbase. They want to see big traditional custodians enter this field and provide these services because they done their due diligence with them. They know them. They work with them for I don't know how many years, and they trust them. And we all know the trust is essential here, right? You can have regulations and all the stuff, but it's still human relationships that have I would say quite a big impact. And once we'll see this, more of these traditional players coming into this, like I said, large custodians, large brokers, and other service providers that are in this industry, then only I think we'll start seeing more of these larger institutions start dipping their toes. Of course, each new institutions coming in helps pave the way, like MicroStrategy, for example, was doing probably for a lot of corporations, or was one of the first. And you will see similar, and we see similar, as I said, maybe first some endowments, family offices, smaller pension funds, smaller insurance companies, but step by step, larger will come as I said, as more traditional service providers will enter the field. This is this is my experience in the traditional, let's say, institutional world that I had in the past.
I think an ultra simplified view of what I think the other panelists shared is, the institutional side has a user experience problem that I think generally has been solved for in retail. What Uniswap and MetaMask and 1inch in the earlier days did for retail, I think it's hard. These processes that Christoph was referring to, there just needs to be a better user experience overall, and I think that'll continue to take place over the next few years.
Understood. I mean, the basically meaning of institutional is like the fund managers who gather the money from the high net worth individual or like hedge funds, and they invest into crypto assets basically. So of course, like as Gregor mentioned, like these people are highly risk averse, and they definitely care about their jobs rather than outperforming the asset, because crypto comes with some sort of like also insecurity, I would say, because one bad news just move the whole market from north to south, as we all know that we are active like 100% into this space. So moving further, I would like to ask like Pavi, especially because in his previous job, he was working with JP Morgan. So maybe he can say more about us, like how the JP Morgan was watching the Bitcoin or the digital assets when it comes to institutionalization, these digital assets.
Sure. And let me first, I guess, comment on the hedge fund piece, because I think this whole thing about like volatility in the market, like hedge funds love volatility. That's how they make money, right? But if you look at like where, and PwC and I can't remember the consulting firm which has done the survey, there's so many hedge funds which are trading crypto, which are offshore based in Cayman. I mean, part of that is tax reasons, but part of that is like a lack of regulatory clarity. I still think it comes down to when we have the regulatory clarity, this will open up the doors for a lot more institutional investments. So on the JP side, I was in the fintech team. They obviously had a mixed view of Bitcoin as an asset class, or crypto as an asset class early on, with very conflicting statements by our CEO Jamie Dimon. I think what they always did from very early on though was recognize the benefits of blockchain technology, and this was kind of like this weird adoption of technology from institutions for blockchain, and then I really hate crypto, which is Bitcoin is basically the inception of blockchain technology overall, which seems quite conflicting. I think they've definitely accelerated on the technology front. They've actually launched now like an intraday repo trading application, which other banks like Goldman Sachs are onboarded on and using blockchain technology fundamentally, and now are only slowly coming around to the crypto investing side. And I think, as mentioned previously, that they're going to like trusts and these types of regular structures versus going to direct crypto owning and trading.
Understood. So moving further, I would like to touch down this. I would like to trigger this topic like DeFi plus KYC, right? I mean, still like institutional ed took figure out like how to invest in digital assets. Then we are moving further. Like this space is moving like at the rocket speed. Basically, 1 month is like basically 1 year in crypto space, as like people who are actively into this space, they say. So basically, they're still figuring out which one to get it, right? And then we are moving further from DeFi to the like KYC on DeFi, and plus there is like a new thing is going on around right now is like NFT. So I would like to ask specifically Christoph, like, what do you think? I mean, will institutional player will figure out like DeFi, and they will also start using this as like some sort of investment vehicle?
Yeah, I think that's a hard piece, right? So we are now 11, 12 years after the inception of Bitcoin, and institutions start to look into that. Let's say perhaps 2017, if you would name a year, which was like the birth year of DeFi. So there's still some years down the road until this again is reaching an area which obviously moves with certain latency. And I would say one of the big reasons why institutionals will have a hard time, even harder perhaps than with cryptocurrencies, to tackle DeFi is, yes, it's even harder to actually find out who is your counterparty. So like if you get a cryptocurrency transaction, if you trade cryptocurrencies, there's a bilateral relationship. You buy, you sell, you have a trading partner. And yes, this is pseudonymous. There's chain analysis tools, which you basically can narrow down the risks. But what now if you put, as an institutional, your liquidity into a balancer pool with a lot of other parties, and then you get returns on that? So like, how is that relating to each other? So with whom are you investing? Is there another party which is like in your pool, which is malicious? Is that black money, whatever? And that can bring you in real trouble. And how to figure that out, I honestly don't have an answer yet. But you know, which you have asked me about Bitcoin 6 years ago, and I said, wow, that's really, really hard for any institutional player to ever do. So there will be solutions. I very much, I'm a tech optimist. People will figure that out as well. Perhaps there will be even like a second class. Perhaps there will be separate products on other compound, etc., which will be like the institution only. Perhaps the yields will be a little bit lower, but then there is kind of a more like closed environment, which obviously is not so much in the philosophy of the things, but business finds its own ways.
Yeah, that's true. I think that's very important. And as you said, Avent, similar, actually working on this already. So you know all your counterparties if you're gonna operate with them in any way. Because this AML directive we're all following, right? With this AML 6, I think comes personal liability also for management of the, and this changes the game, right? It's not only the company that's liable, but you personally can be liable and even go, for example, worst case, to jail if you interacted with some malicious entity on the other end, which you maybe don't know through DeFi. So there are hurdles, obviously, to be overcome. But I agree with Christoph. I think technology can solve all of this if there's a will. And yeah, it will take some time, but they will come. Again, first to be hedge funds, or they're already in, obviously, some of them, and some others, like some family offices, some high net worths, and then more, let's say, traditional players. The same cycle as it was with Bitcoin, it's still playing on, but just a bit later on. That's how I see it, right? And before that, it was only Bitcoin for institutions and nothing else. And now it's ETH and some other assets already interested in, right? And after some time, DeFi will be in the focus as well, and other things that come, for sure. It just takes a bit longer for them to adapt it. Yeah, that's how I see it.
Yeah, the regulations that on the like KYC and AML, I think if you just acronym it, it doesn't really give it the full kind of importance, which is like know your client and anti-money laundering, which are really, really like important functions to stop like criminals and like illegally move money around the world. So the regulations come from a good place. I do kind of worry that just like the implementation, it could be heavy-handed. But I think where this originally may go to, and we're seeing now some DeFi protocols now institute, is when you sign up to a wallet on a new protocol, you have to KYC at that point. And I think that's like the earliest point of entry, which may get kind of more adopted. Obviously, it's opening up, Pandora's box, because things like MetaMask have been around for a long time with no KYC.
I think everybody is educated on KYC and AML now, but I think what goes under the radar are requirements from financial regulators, at least in the US and actually abroad as well, around cybersecurity and other sanctions. And I think that's the other major hurdle that institutions have to get over. I think in good faith, they can't launch a lot of these things because we all have seen the infinite amount of cyber events that have taken place, hacks that have taken place, exploits that have taken place, and institutions can't do that. They can't expose their clients to that. at least in good faith. So I think that is a major consideration for, New York and California domiciled institutions, that, those are the two stringent of cybersecurity laws from a Department of Financial Services standpoint. So we'll get there, but I think they need to have their stuff together before they'll do it at least at scale.
But I mean, moving further, like isn't it, like insurance is also like underrated thing in the crypto space in general. I mean, even though like individual retail investors don't get any opportunity to like secure their assets. So you are actively working in like insurance industry or some sort of like trying to disrupt the crypto space. So what is your in general like opinion about like institutional clients? Do they require like some sort of insurance? And on top of that,
yeah, what institutions, I mean, obviously there are no regulated retail insurance solutions. Setting that aside, historically there was insurance available to institutions, but now what we're seeing is that a lot of major insurers are starting to exclude crypto exposures as part of the broader policies that previously were included on, because it's unknown and potentially catastrophic risk to these institutions. So that's the uphill battle for crypto, is that insurance capacity is already small and it's actually shrinking because of not only the experience that insurers are seeing in crypto, but the broader cyber market is getting hammered, and they're trying to reduce risk concentration and risk aggregation. And I think the easy thing to point to is crypto, unfortunately. So I think that's where I think we see an opportunity for ourselves, at least, and honestly for the broader industry, is that it's a big problem. It's also a big opportunity. But yeah, to your point, it's a massive pain point for our industry, and it's going to be one of the hurdles that needs to be figured out before institutions can really get in there. And I think that's where insurance companies for this space are really going to shine in the near and long term.
Understood. Moving further, before I take like a question from audience, because there is like a really good question coming out from audience side, but I would like to ask before I like more specifically, like institutional investors are also fear like high volatility and lack of liquidity, right, in crypto space. I mean, you are actively working in this trading side, and what do you see? I mean, is there any lack of liquidity still? I mean, volatility is still an issue, as I mentioned previously, like one bad news make market whole north from south. But what is the what is the issue with the liquidity? Still, are we still facing some kind of issue with like liquidity when it comes to like heavy volume on crypto space?
Yeah, I mean, so couple of things. Maybe one thing regarding volatility, and I think Javier also mentioned this. I guess, moving the market north to south on one piece of bad news doesn't necessarily constitute a lot of volatility. As per the definition. What we do see, however, obviously, especially over the last couple of months, is that the volatility has been going up significantly again, and is something like fivefold over what we see in a Euro USD context. But as Javier correctly mentioned, if you have funds that are trading actively and trading a lot, especially in algorithmic trading, obviously, they do love the volatility. So I don't really see this as something that's to be considered as much, of course, depending on the type of institutional investor. In terms of liquidity, look, I think most investors that we're talking about in the context of this panel now are probably only investing in Bitcoin anyways, right? And I personally don't think that liquidity is an issue in a B2C market. When you look at some of the customers that we have, or also some of the very, very specific institutional investors that want to trade on a large range of assets, especially in altcoins and maybe even in some DeFi protocols, then liquidity might become an issue. But for BTC and ETH, I don't see it, especially because all the big exchanges, if the investor doesn't trade OTC anyways, they have enough volume on these markets for sure.
Understood. So there's a question from audience. So I mean, feel free to answer. So can you take us through the steps an institutional investor usually has to go through when going from not owning crypto to owning crypto? Like the whole space is highly focused on private investor, right? Like fiat on and off ramps, exchanges, MetaMask, etc. So the audience is wondering that what's the best way to sell a few $100,000 in crypto without paying excessive fees? So I think he write down like 2-3 questions, but maybe the first question Christoph might answer, like how to go from like not owning crypto to owning crypto, because like you have to convert your fiat into like you have to move into like crypto exchanges, right? You have to do KYC.
To be honest, like that's way general. So even like the question, who is an institutional? So who are we talking about? What are the internal procedures? That is not easy to answer. So where and what is the entity we are talking about here? Where can this entity actually onboard? Because like as an entity, you also need to do a KYC, right? If you want to go to Kraken Pro, which you could perhaps, that could be perhaps a way, like if cheap fees here, the Panda guys, Pavel will perhaps directly take that customer. That is really, really hard to say without knowing more what the best place would be to start to buy your first 100,000s in a cryptocurrency. Depends very much on your organization and your use case.
Yeah, I think when we onboard business users, we ask for, you know, typical information if you're onboarding to a bank. So that would be, you know, your financial statements, you know, who's the beneficial owners, and there's a process which, you know, we have to comply with as a highly regulated institution. And
very thorough process, I might add, as someone who went through it.
I've summarized. And honestly, the Bitpanda one's the best, but that's it. And then you can, you know, fund your account with fiat rails. A lot of people, you know, there's infrastructure providers now who are giving fiat on ramps to crypto specifically. And if you want to buy very large in size where you don't feel like the liquidity is on a single exchange, you can go OTC, which would you know, place your order or manage your order over a period of time, depending on your urgency, and generally get it for you at a lower cost.
I think another thing we definitely can say, there is like a product like we offer, like basically a bank account from which you can directly buy and sell cryptocurrencies. That doesn't exist for institutional investors right now. So we have a B2C product only. We also don't think about extending that into the B2B space, but like a bank where you just open your bank account and then you go to that bank and or you do to your manager, or you even do that in your online tool and then directly transfer between your corporate bank account to a crypto wallet inside that institution. That is not existing. There are, as Pavel said, there are some banks which are more crypto friendly for the on-ramping part, but that's still, then you still need a second entity, a broker, an OTC desk or whatever, who then is connected to that, and you still need to manage at least 2 accounts and manage your liquidity between both of them.
I think prime brokers can have a good angle here, but the thing is they're not really too developed yet. But if you look at the traditional markets, right, prime brokers are obviously a very important player or a service provider for this, because they connect to multiple venues and you have different algorithms you can use with them. We have our own, for example, developed obviously as an asset manager, but for an investor who has a larger ticket that they want to invest into, I think prime brokers could be a good solution. And there are some maybe fees on top of the exchange fees, but some of them, or the majority, are now offering some all-in fee models, which are quite competitive to lower tiers of the exchanges. So I would say this is a good solution. But the problem is they're focused on the largest coins only. And going back to the previous topic, just briefly about the liquidity issue. If you're in BTC, ETH, and some other really largest cap coins, that's okay. But as soon as you're going to dive a bit deeper, and we are still talking in the top 50 assets by market cap, for us as a manager, let's say we have positions which are several million in size for some DeFi projects. It can take us up to, I don't know, several hours to go in or out into a certain position. With our algos, with classical, it's not even possible. So I would say liquidity is still an issue depending on how deep you want to go into the market, right? But for the largest ones, I agree that the liquidity is sufficient. The market will not even move if you want to jump in with some larger limit order of 100K, for example, with BTC, easily done without any problem.
Sagar, may I jump back to the original question and my original answer? I now found a really smart answer I want to give on that.
Sure.
No, it's like
really,
really helpful one, because like
yeah.
instantly I didn't get up with that. If the question of that participant is so general, the first thing I would really recommend is to get a really good consultant who has a background in the crypto community, and perhaps another foot in like from their CV in the traditional financial system. There are several ones. If you don't know who to go to, ping me on LinkedIn. I'm happy to make a connection to someone who is reliable and has a good reputation. And then this person helps you if you should go to Bitpanda more, or rather to Kraken, or how you should start the journey, and what is actually your strategy to start that journey. That is perhaps the first thing to do.
Understood. So regarding the LinkedIn, I would also like to ask all of you panelists if you can share your LinkedIn link in the chat box below, so also audience can connect with you and maybe reach out to you in the later on time. So moving further, like let's discuss about technical know-how. I mean, as we are active in crypto space, maybe many of us can easily handle like DeFi, liquidity provider, staking, and so many other things, right? Like DAO and all. So what are the key hurdles for the traditional financial market or like institutional players when it comes to technical know-how? I mean, it's not that easy, right, in crypto space to buy. I mean, if somebody wants to buy Bitcoin, maybe it's easy for them. But let's say when it comes to move their asset from exchange to their private wallet or ledger or custodian. So what are the biggest challenges they are facing in terms of like technical know-how?
I can only speak for trading at this point here, and what I've been seeing over the last year, 2 years, is that really a lot of infrastructure provider and technical provider have been developed here. I think just yesterday or 2 days ago, Alpaca announced that they closed a $50 million round, and they would also move into crypto. What they're providing essentially is development API and tech infrastructure for trading apps of all sorts, right? So there's a lot of technical infrastructure nowadays that can be built on. In Germany, we see the same, with a lot of players evolving and emerging, and also evolving, providing all different levels of the technical processes that are needed. There's a bunch of very good custody providers. There's brokerage providers. There's several banks that have gone into this space. So you're at a point now where you can almost sort of plug and play your ideal setup if you want to have a crypto trading setup, one that you can actively use for active trading, beyond just buying once or twice a certain portion of Bitcoin. It does still take a little bit of configuration and setup, but we're seeing a lot of involvement happening there over the last I would say 2 years, and a lot of opportunities to build upon now already.
I think there's different like institutions, depending on where they're from, are coming at it from different angles. So I think we were probably one of the first crypto companies to then launch stocks, but a lot of the stock trading kind of places and banks have enabled their customers to buy crypto too, which is making it easier for everyone overall to access the crypto ecosystem and really on ramp. We also then launched our B2B white label offering, so you can integrate Bitpanda's licenses and technology into your own application. We're working now with a really large neobank with millions of customers to enable their stock and crypto trading too.
Maybe Sagar, you said about moving, assets from exchanges to DeFi protocols to whatever, there now, and of course, the topic with institutions is always the permissions, right? Who has access to certain things, who can sign the transaction, stuff like that. And to build this on your own as an institution, not being in crypto, is really hard. But you have players like Fireblocks and similar who really solve that quite, I would say, on a high level. And I know many companies use them. We also, for example, and very happy with their solutions on that end. So there are different service providers providing all sorts of solutions for crypto. And as we can see, month over month, there's just new players coming in, new solutions, new upgrades, and it's getting more and more better, right? Better and better with the user experience and everything. So there are solutions in the market. If you look around, it's quite easy to find a lot of that.
Understood. So let's talk about like investor protection regulation. I mean, when you jump into like traditional financial market or stock market, there is like always some investor protection regulation, right? And when we talk about like crypto space, there is no any kind of regulation, or there is like work in progress kind of thing. So I mean, what kind of regulation are we expecting in next 1 or 2 years down the road from the regulation? And like it also should not curb the like a whole innovation, right? In terms of like blockchain is like transparent and crypto assets is movable. So basically you can also keep in your wallet. But when we talk about like institutional, definitely they're not going to hold their own Bitcoins. When I talk about, especially for example, MicroStrategy, Michael Saylor always mentioned in his podcast or YouTube channel that though he's like Bitcoin maximalist, he don't have the custody of his own Bitcoins. I mean, basically. So what are the like investor protection regulations are we going to expect in the upcoming days?
Let me jump into that. Being a CFO, I have one topic which normally doesn't come to mind as the first regulatory topic. It's always about banking laws and KYC, etc. But tax is a real issue. And we have seen that with the US discussion in the infrastructure bill. And in Germany, we have also like on taxation of lending activities, currently discussion on the level of lawmakers and the Ministry of Finance. And I would say that also has a good reason. Like there's a lot of wealth which has evolved basically from nothing, which has created itself in that ecosystem. And now a lot of people have personal wealth and gained wealth, and institutionals more and more also are coming into the space. So how is all of that taxed? How was it taxed? How is it taxed moving forward? Which tax rules applied or will apply? So there's also a lot of question marks around that. And I would say, since governments have a high urgency to find ways to raise more taxes, given the high indebtedness of states, that is an issue which will keep us busy over the next years. And again, like we see the same thing as with banking regulation and other regulatory areas. There's very few harmonization between countries, even less in the EU on the tax side than on banking or payment regulatory side, and that will create a lot of friction in our industry and for all of our services.
Understood. Anyone like to add something, Pavir? Yeah. I
mean, yeah, from our view is that there's going to be companies which are focused on the tax problem, just like AEB is focused directly on the insurance problem. And our idea is just to partner with them. So we would continue to be the exchange, but then the integration to the relevant tax reporting services will just be a partnership for us, and definitely something which is actually available for our clients currently. The only other kind of thing which you said, regulation for the future, which is the MiCA or MiCA markets in crypto assets regulation, which is I guess due to be published at some point, and maybe into force into the next 3 to 4 years, which I think is it's really good for the whole European Union, because it unifies all these different jurisdictions, interpretations of like AML laws. And I think when you mentioned investor protections as well, right? So the reason why Germany is so good as a country to do crypto business is because crypto is considered a financial instrument, and that comes along with it with associated investor protections overall.
Understood. So before we close this, I would like to ask also the last, your remarks, all of you, so world traditional financial market is about 200 trillion, right? And we are sitting today as of market sits at $2 trillion. The crypto whole market, which includes also lots of scammy and projects, but they consider wholesome, of course. So again, comes to liquidity, I'm sure we'll not manage to liquidate 2 trillion as of now. But let's say still people consider this is highly speculative space, right? Bitcoin moved from 5,000 last year March today, like almost 50,000, like 10x, and other DeFi protocols and all assets moved to like 100x, 200x. Still, we are sitting at 2 trillion. So, I mean, what percentage are you guys expecting, like when we compare with the traditional financial market, like we are heading to next 5 years in terms of like market valuation of whole crypto space and industry?
I'll just start. I'm in this financial industry for the last 20 years, and one thing I learned is not give out any projections for the next 5 years. We all expect multi-trillions, yes, but who knows? There are so many factors that could happen in the next 5 years. So I think it's just impossible, and this goes for all the projections and analysis and expectations of different analysts. They usually miss it by a huge margin. So it's just, I think, a task not worth really taking. Or that's just my 2 cents on that. And I'm a professional asset manager, and clients always ask me what they think about Bitcoin by the year end and all the stuff. I have no idea, because nobody has.
along those same lines, like when Breach was started, the market cap was $150 billion, and for me, I thought that was a massive business that could be created just off that market capitalization alone. So to maintain like our objectivity, we don't really care, candidly. Like it could go back to that, and we'll still be doing what we're doing, and I think it'll be an awesome business. But yeah, I mean, to Grigor's point, we don't speculate on the thing. We do think that it's still very early. We think that there's still a lot of work to be done, both for retail markets as well as commercial institutional markets. But yeah, like I have a very conservative viewpoint just because of when we started and why we started this.
Yeah, maybe just to add here, I still expect this market to be magnitudes larger than it is today, but I don't know where it will be in 5 years. That's just the case, right? But in the long term, I'm also extremely bullish. Otherwise, I wouldn't be in this industry for sure. But yeah.
I think that giving a number is super hard, and I don't think anyone here is going to give you a number. But currently, there's not actually that much tokenized like real world assets or tokenized like securities, for example. So it's like this whole missing piece, which is currently missing in the crypto ecosystem, and it's only been kind of digital assets and digital kind of currencies. So that if we're here and all these massive asset classes are missing, it's only going to grow.
So basically, Pavel, you're making point here, like everything is going to be tokenization, right, in the upcoming days. And I'm sure, like
I don't know about days, but
I'm sure Ehab will have something to say about tokenization. Yeah.
No, nobody wants to be a quote here.
No, but would love to hear your opinion about tokenization. Then, sorry to interrupt between this question, but still.
So yeah, I think it's quite hard. We've seen lots of people try across like liquid instruments, so say arts, real estate, to moderate success. I think some things are tokenized, and you don't even kind of think of it because it's not really using blockchain technology. A good example of that is like Masterworks, which does like an IPO for a piece of art. And so, yeah, I think that will eventually move to blockchain technology just because of the efficiencies. And at that point, it is basically tokenized and fractionalized. Well, when we get to like things like real world assets and real estate, I think it's pretty hard because obviously it comes back to the regulations. If there's no regulatory clarity, people are unwilling to do it.
Understood.
So what's the saying, like coming back to the other question, like people when it's about innovation, people overestimate what's happening in the next 1-2 years, but highly underestimate the impact in 5 to 10 years, right? And I'm an optimist by heart, and I really believe in 5 years plus, the average fund, is it managed? Is it a pension fund? Is it like even like a corporate fund? Is it corporate treasury? The average portfolio will have 5 to 10% crypto investments. That will be a very normal part of the whole asset allocation. And if you then think this through, what that means for the market capitalization, that is insane. That is definitely what Gregor said, a magnitude of where we are today.
Definitely, this is like a bold statement, but of course, this is going to happen. I mean, of course, like my question was not more like price prediction terms, but like how big. I mean, we can see like lots of development is going on, and maybe in upcoming days, like we will also have like some kind of insurance by using breach insured, that when I'm buying my next Bitcoin, maybe not whole, but maybe small fraction, then I can also insured, right, by using breach insured. And yeah, of course, like there are like other use cases, and I think there's only like 10 to 20% people are still in the like whole crypto space, and like lots of work to be done. And thanks a lot, all our panelists. And in closing remarks, I would like to say, like we can see like more and more startups tackling the lack of infrastructure and service needed by institutional asset managers to operate crypto. We believe this wave of infrastructure will be crucial to onboard institutional asset managers that are waiting on the sidelines. It's important to mention that the infrastructure and financial service being built are the same needed to operate digital assets such as security tokens. So with an increasing number of assets, managers connecting to institutional class softwares and services for crypto, we also expect it will help the distribution of rapidly evolving security token industry. So that topic I'm leaving for our next panel event, right? So I would like to thank all of you once again for your time and your valuable insight. And for the audience, thank you for joining us. Please follow us on LinkedIn and Twitter for all the recent updates. Then I would like to hand over to my colleague Alexandra. So always like last word goes to the Disrupt Network.
Great. Thank you, Saga, and all the speakers for the wonderful discussion. And to all participants, if you want to discuss about digital assets, you can join our WhatsApp group to keep in touch and keep discussing. And we hope to see you in our upcoming events. Goodbye.